income statement after the cash flow, then the adjustment is classified as a deferral or an accrual. So when the income recognition is after the cash comes in or out, is that an accrual or a deferral? All right, so when the cash happens first and you defer recording it on the income statement, that's a deferral, right? So this would be an example of like prepaid rent, prepaid insurance, or when you receive cash in advance, unearned revenue, and you have to do the work later. All right, next one, number 2. Which of the following is not true of adjusting entries? So they always result from an error or mistake. They never involve cash. They include both a balance sheet and an income statement account. They usually result because of the passage of time. Which one of these is not true? Okay, so it is possible that you make an error, like on your group project, there was an error and you had to fix it, so that would be considered an adjusting entry. But normally, well, we said these 2 rules are true. They never involve cash, and they always involve one income statement and one balance sheet account. But they usually just happen because of the passage of time, right? You've used up your prepaid rent, you've used up your prepaid insurance or whatever, and so you have to make an adjustment at the end of the period. So the answer that they always result from an error or mistake is not true. Question number 3. Which of the following are powerful incentives to manage financial statements? To reach management bonus thresholds, to avoid reporting a loss, to meet Wall Street analysts' expectations, or perhaps all of the above? Which of these would influence managers to manage earnings? Okay, hopefully you got all of the above because we talked about all of those last time. Number 4, which professional is independent and can enhance the credibility of financial statements? Would that be a member of the board of directors, the chief financial officer, the auditor, or a stockholder? Who's independent of the company and is going to provide assurance about the credibility of the financial statements? All right, so that's the auditor. Last question. What is the primary job of a company's managers? Are they there to manage earnings? Are they there to maximize shareholder value? Are they there to reach their own bonus thresholds? Or are they there to audit the financial statements? What are managers hired to do? Sometimes we sit here staring at each other for like 20 seconds waiting for it to end. Okay, so obviously shareholders, managers are there to maximize the value of their shareholders. And so that's why we kind of run into some of those issues we talked about last time where they're sort of torn between their personal incentives and what their incentives should be to help the shareholders. All right, so just a quick reminder that your group project is due tonight, along with the group evaluation. So I hope you all got the email from me. The group evaluation is kind of like a Google survey. You have to just go on and record the name of each group member, and then you rate them. So if you haven't done it yet, it's a scale of 1 to 5. A 3 means they just did their part. Just everybody, if everybody does a fair share of the group project, you all kind of work equally, then everybody gets a 3. If you have one person that really went above and beyond the call of duty and you want to just sort of reward them, you can give them a 4 or a 5 just because you feel like they really helped the group a lot. If you have somebody who like never showed up to the group meetings, didn't contribute at all, they should get a 1. Right? So hopefully everybody is at least getting a 3. But again, if you do have people that didn't help, didn't show up, then you can give them a lower score. All right? And again, this is important because we don't want to give credit to people who didn't contribute, but we also do want to sort of reward those who did kind of go above and beyond the call of duty. All right, any questions? Oh, by the way, one more thing about the group project. So we posted the transaction spreadsheet from Part A. So you know exactly which accounts should be the right answers, right? So if it says cash and supplies, you know those are the accounts, and you know the amounts those are given, and so you just have to convert that into an increase or a decrease using a debit or credit, right? So you're going to record all of your journal entries for the transactions. At the end of the period, there were some adjusting entries that you made, obviously, and then you also have to do closing entries. You'll post all of those over to the T accounts that are the ledger, right? And then you'll use those ending balances to create your financial statements. So if you have any questions, please go to the accounting lab. They're open until 9 o'clock tonight. And obviously, it's due by midnight tonight, right? So if you haven't done it yet, you need to jump on it and get it done right away. All right, so today's an important turning point in the class. The first midterm is the one that tends to really blow people out of the water because they're not prepared for it. So I want to be very clear. I post a practice exam on NBC. In fact, if you look on there, the practice exams for exam 1, 2, and 3 are already posted. So if you go there, look at exam 1, here's what I want to make a really important point. These exams have 15 multiple choice questions, and then usually 1 or 2 kind of big, long workout problems. So today's kind of the tipping point, because the multiple choice questions test everything we've learned so far. Everything about transaction analysis, everything about the income statement, the balance sheet, statement of retained earnings, how those all fit together. Obviously, if I'm only asking you 15 questions, they're fairly comprehensive. Several times during the class, I keep pointing out this one slide. I say it all kind of hinges on this. It's the accounting equation. How does everything flow into the accounting equation? Right? We have assets equals liabilities plus equity, but equity includes retained earnings, right? Retained earnings is made up of net income minus dividends, right? Accumulated earnings over time. And so you have to know how the income statement flows into retained earnings as well. A lot of times you're going to be given information about all the different accounts and you have to solve for something that's missing. It's really just algebra, but it's comprehensive. You have to really know how all the financial statements fit together. So I can't overemphasize the importance of practicing. So what I would suggest to you, you got this weekend, right? Go practice the multiple choice questions from the practice exam. And some of them, I'm telling you, the first time through is not enough. You're going to be like, oh my gosh, this is hard, right? So if I were doing it, I would kind of review a chapter. Just look at my notes. I don't think you need to reread the chapter, but look at my notes. Make sure you feel comfortable, and then go back and do the practice questions. The answers are at the back of the practice exam. You may have to spend some significant time on this, and I would suggest go to the accounting lab. You might hang out there while you're doing it, and then you can ask questions as you go along. You need to get to the point a week and a half from now when you can just print out a fresh copy of that practice exam and work it all the way through perfectly if you want to feel confident that you're ready for the exam. Okay? So up till now, you know everything you need to know to do the multiple choice section. Starting today, we're going to learn what we need to know for the workout problem. There's one big comprehensive workout problem on the statement of cash flows. This is a really difficult topic. I know you can do this. A lot of the other instructors who teach this class, they save it for the very end of the semester. But I think you can do this. I've done this a lot. I want to keep the statement of cash flows with all the other financial statements. I'm going to stretch you. Over the next week, you're going to feel stretched. If you'll just kind of hang with me and work hard, I know you can do this, and you can do well on this exam. I'm going to give you lots of practice. Once you kind of figure out the system of how the statement of cash flow works, you can nail it every single time. It's the only financial statement where you have an answer key before you start, because all you're trying to do is explain the change in cash. So I'm going to show you every problem at the very beginning. We tell you the change in cash. So you know the answer. You just have to know how to solve for it. Okay? So we're going to begin now. And so today we're working really hard on learning how to do the statement of cash flows. All right, so I'm going to start off kind of high level and explain what the statement of cash flow is and how it works and why we do it. The last part of class, and this is the important part that's on your handout, I'm going to start teaching you how to do the statement of cash flows. The homework that's assigned for next Tuesday is probably the most difficult assignment because you're only going to have these examples to help you figure it out. So again, try to hang with me today. I know this will be a difficult homework assignment because you're going to have to just do it based on what you learn here. Then next Tuesday when we come back, we're going to practice a full statement of cash flows together. And then before we come back for the next class, which is the exam review, you're going to have 2 more practice problems so you can work the whole thing. And so hopefully by the time you've been through all of that, you'll feel pretty confident with it. All right, so statement of cash flows. What is it? Well, we know what the balance sheet is, right? It's the accounting equation. It's how we balance out. What assets do we have? What liabilities and what equity do we have? The income statement gives us that sort of video of how we performed during the period. Right? Revenues minus expenses equals net income. And of course, our focus today is on learning the statement of cash flows, which is, remember the bucket? We're explaining the change in the water level, how much cash went up or down during the year. All right, so cash flow, again, is simply the change in cash. So at the beginning, as a problem, if I give you the beginning cash balance and the ending cash balance, then you can calculate the change, right? That's the answer to the problem, really. But you're trying to explain why cash changed by breaking it up into operating activities, investing activities, and financing activities. All right. So what are the purposes of the statement of cash flows? You as an investor or as a manager, you want to be able to understand what cash came in and what cash you paid out, and to be able to explain what's happening. So it answers a lot of useful and important questions, right? You want to be able to predict the company's ability to generate future cash flows to keep the company running. You want to be able to, if you're a banker, for example, trying to decide whether or not to loan money to a company, are they going to be able to make their interest payments? Are they going to be able to meet their current obligations? And of course, if you're a shareholder, you want to know, are they going to be able to pay me dividends down the road, right? So how well they can generate cash is a really important thing to know about any business. All right, so here's my example, and I'm going to always come back to this. If you can remember this picture, you can understand what the statement of cash flows does, right? So we have a bucket here. We have 3 faucets flowing into the bucket and 3 holes at the bottom flowing out of the bucket. And so what we're trying to do is explain the change in cash by breaking it up into 3 types of activities. So operating, investing, and financing activities. So we have inflows from all those types of activities, but likewise we also have outflows from all those activities. So outflows from operating activities, outflows from investing activities, and outflows from financing activities. Ultimately, the purpose of the statement of cash flows is simply to explain what happened during the year, the change in the water level, how much cash went up or cash went down during the period. If you can keep this big picture in mind, it's not hard, okay? Now, what's cool about this, mathematically, it's very simple to explain, and I'll show you a little example in a minute about how to do that. All right, so I'm going to start kind of broad. What are operating activities? So operating activities, that's the main way the company makes money, right? So if I sell products, then my operating activities are all the things I have to do in order to sell products. If I'm a service company, then my job is to provide services for people. What are my operating activities? Everything I have to do to be able to provide those services, right? So when you think about operating activities, we're going to have inflows and outflows. So let's think about the inflow side first. So what are my 2 main ways of bringing in cash? I either sell products or I sell services, right? So the 2 main types of inflows are going to be the sale of goods or providing services. Okay, so those are the main sources or inflows of cash from operating activities. There are a couple of other ones that go here, and I'm just going to plug them in for you. These go here because the Financial Accounting Standards Board said so, basically. But interest received and dividends received, technically, if you think about it, when you invest in someone's stock or you lend somebody money, that's when you receive interest or dividends. So you would kind of think of those as really investing activities. But as we sell this, we have to put those in the operating section, okay? So even though they don't necessarily fit, I think those 2 main ones are obviously the obvious ways that companies generate cash through operating activities. But we have to put these here as well. Okay, now, just kind of turn your mind to the opposite side here. So if you want to think about outflows, if we make money by selling products, what related outflow would have to be there in order to sell products? You have to buy the inventory to be able to sell it, right? So the main outflow for a merchandising company would be what? The purchase of those goods that they sell, right? Think about a service company. If the main inflow is from providing services, what's your main outflow? Do you have to pay people to do the services? You have to pay your employees. Okay, so the main outflow from operating activities would be the payment of your employees. All right, now, kind of think about this side here. Also you have to pay for your operating expenses, sorry. So, pay for your rent on the building, you got to pay for maintenance, all those kind of things. So just any kind of operating activities, operating expenses. But then related to these here, sometimes you borrow money and have to pay interest, and so that has to go there as well. So again, these red ones, I just want to point out, they don't really make sense as much, but this is where the FASB have told us we have to put them, so they always go in the operating section. What's the obvious omission here? Interest received, interest paid are both operating activities, right? Dividends received, what's missing? Dividends paid. So I'll show you that one later. Dividends paid goes in the financing section. All right. So here's the overall rule I want you to remember with respect to the operating section. The operating section is related to, on the balance sheet, your current assets and your current liabilities. Every time you have an operating activity, it's going to be tied to those types of accounts on the balance sheet. All right, investing activities. So I invest my money in assets that are going to help me run my business, right? So let's think about the outflow side first. What types of things would I have to invest in to run my business? Do I need buildings, equipment, trucks? Sometimes I need airplanes, right? Whatever. So purchase of plant assets, that's going to be a major outflow. That's a major investment. What other kind of things do I invest in? Well, sometimes I have to purchase, if I have extra cash, I'll go out and buy stocks or bonds of other companies. I'll invest in other companies. Sometimes I'll go out and buy a new business segment. So let's say that I want to vertically integrate. I want to purchase one of my suppliers so that I have better control over the products that I'm buying. So if I'm going to buy another business segment, that's what that might look like. And sometimes if I have lots of cash, I'll just lend money to other people. So those would all be considered investments, and they're outflows of cash, right? So let's now turn this around and think about the inflow side. So think of a parallel here. So if buying plant assets means I got to pay cash, what might be a parallel way that I could have a cash inflow? I might sell that building later, right? I bought the building and paid cash, but later I sold the building, and so I'm going to have a cash inflow. So the sale of plant assets would be the inflow. How about these other two real quick? So if I purchase securities, that's cash outflow. What happens if I sell them? Cash inflow, right? So just kind of think of the parallel here. Sale of securities. What else? How about the sale of a business segment? I can spin off part of my business, right? And if I'm making loans to people, I lend them money, give them cash. What would be the opposite, the inflow? When they pay it back to me, right? So I make a loan and they pay me back. And so the collection of principal on loans would also be considered an investing activity. All right, here's the big rule, the general rule about investing activities. Investing activities are always associated with long-term assets. Okay, real quick review. We did the operating section first, right? What accounts on the balance sheet did I say are associated with operating activities? Current assets, current liabilities. And then I just told you the investing section is related to what part of the balance sheet? Long-term assets. Very good. All right, let's do financing activities. So financing activities, remember your accounting equation. Assets equal, what's over here? Liabilities plus equity, right? So in other words, the accounting equation says you got a bunch of assets. Where did those assets come from? You had to raise money somehow, right? You either had to borrow money, liabilities, or you had to get people to invest in the company through stock, right? And so the ways that we bring in cash, those are the ways we finance the purchase of our long-term assets mainly, right? So cash inflows could come through issuing stock or from borrowing, right? So there's two ways of borrowing. If you borrow from the public, you sell bonds to the public, or you can borrow from a bank, so you issue notes, right? Long-term notes payable. So those are the cash inflows from financing activities. So turn that around and think about the associated cash outflows. So when I issue stock, so I'm going to print up stock certificates and sell them to investors. They're going to give me cash. That's the inflow. What are the associated outflows? So if I issue shares of stock, I got to pay dividends to my shareholders. That's an outflow, right? if I'm borrowing money, so if I'm either borrowing money from the bank or selling bonds, sometimes I need to pay back the principal, and so that's going to be the associated outflow. And then stock is an interesting one because when you sell shares of stock to your shareholders, they give you cash. Sometimes you go out and buy that stock back, and that's what we call treasury stock. So treasury stock is something we'll learn about at the very end of the semester, but that's what that is. All right, so here's the general rule, or the key to remembering the financing section. Financing activities are associated with long-term liabilities and equity. All right, so this next little part, I love to think about it this way because you've all had math classes. The accounting equation is so simple, right? Assets equal liabilities plus equity, and it's always true. Well, the statement of cash flows, and I told you, we always give you the answer up front, right? Well, here's how simple it is. The accounting equation has to hold true, right? Assets have to be equal to liabilities plus stockholders' equity. So we can break this up. Well, we can also say the change in assets equals the change in liabilities plus the change in stockholders' equity. We can break up the asset section and say, well, what are the kinds of assets we have? We have cash and then all the other assets, right? I'm trying to isolate cash here. So if I rearrange the equation, what do I get? The change in cash equals the change in liabilities minus the change in other assets plus the change in stockholders' equity, right? Mathematically, the answer has to be the change in cash, that's the change in the bucket, the water level of the bucket, right? That has to be equal to these other changes that I've listed on the other side of the equation. All right, let's get a little more specific here. So if you take that starting point, we can break up the liabilities and other assets into two other categories. We have short-term liabilities and long-term liabilities, short-term assets and long-term assets. I can rearrange them a little bit. So I get change in cash equals the change in short-term liabilities and short-term, long-term liabilities, and the change in short-term assets and long-term assets. Do a little more rearranging here. So I've got all of my short-term stuff together, all my long-term stuff together. And then what can I do here? Okay, remember we said short-term assets and short-term liabilities are associated with what kinds of activities? Operating activities, right? And long-term assets are associated with what? Investing activities. And long-term liabilities and stockholders' equity are what kind of activities? So those are going to be the financing activities. So again, short-term liabilities and short-term assets, the changes in those accounts are associated with operating activities. The changes in long-term assets are associated with investing activities. And the changes in long-term liabilities and stockholders' equity are associated with financing activities. Guys, this is the statement of cash flows. It's very simple. We want to show the change in the water level, right? That's the change in cash. How do we explain it? We explain it through operating activities, investing activities, and financing activities. And if you can just remember those general rules, operating activities are associated with the short-term stuff. Investing activities are associated with long-term assets. And financing activities are associated with long-term liabilities and stockholders' equity. That's it. That's how easy the statement of cash flows really is. All right, so here's a balance sheet of a company. And notice the colors here. What color did I use for operating activities? Green. What color for investing activities? Red. And financing activities, blue, right? So if I just look at any balance sheet, these colors start popping off the page at me. So notice that all the short-term assets and all the short-term liabilities, they're green. Those are operating activities. All of the long-term assets are red. That's the investing activities. And then most of this other stuff over here in the long-term liabilities and stockholders' equity section are going to be financing activities. All right, so just one other point here. Notice I have one stray green number here in stockholders' equity. Technically, in retained earnings, we've got net income, right, which is an operating activity. And also, you notice that up here in the short-term liabilities, I have one exception to the rule. So it is a short-term liability, but which one is it? Dividends payable, right? And we said dividends go in the financing section. So that's the one exception to that general rule that I gave you. All right. So that's how the balance sheet sort of links to the statement of cash flows. All right. So here's a simple example of what's called the direct method for preparing the statement of cash flows. We start off with the operating activities. What kind of operating activities do we have? Well, we have cash received from customers and cash paid to our suppliers. Then we have our investing activities. We have cash paid for acquiring long-term assets, and then cash received for the sale of some long-term assets. The financing section is going to be made up of a bunch of things. Cash received from the sale of stock, cash paid for the repurchase of shares of stock, cash paid for dividends, cash received from issuing debt, and cash paid to repay debt. So if you kind of add up all those pluses and minuses, you end up with your net change in cash, right? That's the change in the water level. If you add that change to your beginning balance in cash, then that's going to give you your ending balance in cash. So this little part right here at the very end of the statement of cash flows, this is like the easiest points on the exam because it's given up front. We tell you the beginning balance in cash, we tell you the ending balance in cash, and you can calculate the difference between those two. That's the change in cash. So let me just point out one thing. When you get to the exam, everybody ought to get that part right because that's given to you. So make sure you don't forget to write those down and claim your free points there at the end of the exam. All right, so I'm going to show you one more step because notice this is what we call the direct method. We'll explain the difference in a few minutes. By the way, the difference between the direct method and the indirect method for calculating the statement of cash flows, it just has to do with the operating section, really. The rest is all the same. Okay, so here's the equation we just looked at a second ago. Let me get you back to the indirect method. Okay, so the change of stockholders' equity, I'm talking about retained earnings is in there. So change in retained earnings, what causes a change in retained earnings? You have to add net income and subtract dividends, right? Okay, well, net income is an operating activity, so it needs to go over here with operating, and dividends are a financing activity, right? So if you think of it that way, net income goes over here, and dividends is going to go over here. All right, so the indirect method for the statement of cash flows, what did I do? The indirect method says we start with net income, plus or minus all the changes in the current assets and current liabilities, right? Plus or minus the changes in the long-term. So this is the operating section. And then we have plus or minus the changes in the long-term assets to get the investing section, plus or minus the changes in long-term liabilities and stockholders' equity to get the financing section. So the key is right here. The difference for the indirect method is that we start with net income and we make some adjustments from net income to get the operating section. All right, this will be a lot more clear as we go through some real examples. All right, so what does the statement of cash flows do? Essentially, we start with a company, they have regular transactions, business activities taking place. Cash is going to be coming in and out during that period. And so that would result in operating cash flow, right? Well, what did we talk about in the last chapter? We talked about accruals and deferrals, right? So accruals and deferrals, that takes care of the timing differences between when cash is paid and received and when we record those items in the income statement, right? So if we record all those accruals that we've talked about, that gets us to net income. And so let me just quickly review with you with adjusting entries. Remember adjusting entries? We said they never involve what? Never involve cash, and they always involve at least one income statement account and one balance sheet account, right? So if you take the net income number and you undo those accruals, then it's going to get you back to the operating cash flows of the company. So the operating section of the statement of cash flows starts with net income, if you're doing the indirect method, starts with net income, undoes basically all the changes in the current assets and current liabilities to get you back to the operating cash flow number. All right, so when you're preparing the indirect method for the statement of cash flows, what do you need to know? You always have to have an income statement. You got to have 2 years of balance sheets so you can compare to see what the change in every account was. And you're going to have some other selected information about transactions that took place. So whenever we give you a statement of cash flow problem, this is what's given up front. And then if you're doing the indirect method, then you're going to start with net income, calculate all the changes in the current assets and current liabilities, and that will give you your operating cash flow number. So we'll show you how to do that in just a couple of minutes. All right, so what I want to do now is start with an exercise. So if you take your hand out, upper left-hand corner, I have given you here 3 companies. And so what I want you to do is assume this scenario. Just assume there's 4 of you in your group or 5. You guys represent the board of directors for a bank. And you've received cash flow data from 4 companies. Company A, Company B, Company C, and Company D. All these companies are exactly the same size in terms of total assets. And assuming that you can only lend money to one of those companies, which one would you want to lend money to? So you have cash inflows, plus positive numbers, and cash outflows, negative numbers. And they're split up into operating, investing, and financing activities. So obviously these 4 companies are different. So what I want you to do is introduce yourself to your group members. Take a look at these 4 companies and kind of look at their cash flows, inflows and outflows, and try to come up with, you have to choose one and only one company, and then also choose a spokesperson for your group to tell us which company you're going to lend the money to. Ready? Go. Hey guys, sorry, there's the information. Hey guys, let me remind you, you can only lend money to one company, and you're going to have to cast a vote here. So you got to make a decision. Who gets the money, and what's your rationale? Take another minute. All right. Who's your spokesperson for each group? Spokespersons, raise your hands. Who's going to be the spokesperson for every group? I need one from every group. I see a lot of people not raising their hands. Tag somebody. Who's going to be the representative for your groups? All right. Okay, put them down. Here we go. Every group has to vote. I want to see who you vote for. All right. How many of the groups decided they would lend the money to company A? Raise your hands. Okay, great. How many groups decided they would lend the money to company B? Raise your hands. Good. All right. How about company C? Anybody? Okay, that's the company with negative cash flows. All right, good. And how many of you thought company D? Raise your hands. Okay. Awesome. You guys, this is one of the best splits I've ever seen. So you kind of split kind of evenly across the groups, right? So for those of you who voted for company A, raise your hands again, company A people. Okay, tell me, why would you pick company A? And I just want to know, why would you pick them? So what are some thoughts? Yeah.
So for the cash flow from operating activities, they're making $50,000, and while company C is making more in operating activities, if you look down at the net change in cash, they're losing money.
Okay.
For company A, they're actually gaining money.
Okay. Okay, so you said two things: positive operating cash flows, which is one thing, and they had a higher number down here in the just overall change in cash, right? They had an increase. Who else was company A? Anything else that you guys thought about? Yes, over there. Okay, so the point there is, so you're saying you did vote for company A or you did not? I did. Okay, so one of the things that's going on here, they're actually selling off some of their long-term investments, right? And so that helped them to generate their positive cash flows that they have. All right, who voted for company B? I had some company B. Raise your hands. Okay, so why did you vote for company B?
We said when we looked at the cash flow for operating and investing, that even though it's a negative number, it could be better for short-term and long-term because they're both investing and purchasing.
Okay, so they're continuing to invest in new assets because they're maybe trying to grow, right? In fact, I'll point out a couple of things here. The first company is what I would consider to be an older, stable company because they are generating positive cash flows, right? They're actually selling off some of their assets, so maybe they've decided to downsize some of their operations. What does this negative cash flow from financing mean? They're paying back some of their debt, right? So they're generating some positive cash flows either from selling off unwanted assets and from operations that they're able to start paying back some of their debt. So that could be a positive sign of a kind of a strong, stable company. This company right here is, who else voted for company B? Somebody. Come on, guys, raise your hands. This is a great company. So Parker, right? Why did you pick company B?
I'm not entirely sure.
Okay, group members, help them out. You can help them out.
Well, we saw that it was a lot different than the rest of them. So we saw it had a negative cash flow, the cash flow from operating activities, and then we saw that the net cash from financing activities was really high.
Yep.
And they turned out they still had a net change in cash.
So there's an increase in cash overall, right?
Yes.
All right. So I'm going to tell you something about the company you guys picked, and let me give you some backing here. Okay, this is what I would call a growth company. So maybe they're a startup, right? They're kind of a new startup company. So when you're first getting going, is it likely you might have some negative operating cash flows in the early years? Yeah, you got to get things up and running, right? You got to get your products selling, things like that. So it's likely that a startup company will have negative operating cash flows. What does this mean right here? Negative investing activities? They're buying up assets, right? They're trying to get the business up and running. How do they finance that? They're bringing in a lot of money through borrowing and issuing stock. Okay, that's the definition of a startup company. Now, if you guys were stockholders, then if you picked a good company, that's a good investment because over time, what's going to happen to your stock price? It's going to go up. Okay, now I would say from a lending perspective, you might be a little nervous about lending to them because they might be risky, right? But there's a high upside potential in terms of if you're investing in their stock, right? Okay, company C. Who picked company C? All right, why did you pick company C?
Because it had pretty good operating.
Really strong operating cash flows, right?
And it looked like they're trying to grow and invest.
And they're still continuing to invest. They're still growing. Back row. Are you in the same group?
No.
Okay, so why did you guys pick that company?
Pretty much the same reasons. Like it was net, the net change was a negative, but I mean, if you look at why, because they're actually repaying debt and investing in more like they're investing much time in that kind of stuff. Plus that's
Okay, really good idea. So I think a lot of times people shy away from this because they're the only one with a negative cash outflow, right? But think about what they did. They generated so much operating cash flows that they're able to start, they're still investing in new assets, right? They're buying, expanding, and growing. So this is definitely a growth company, but they're actually paying back debt and paying big amounts of dividends, and they still come up, a little bit negative, but they're a very strong company, right? Okay, really quickly, who picked company D? All right, Brett, why'd you pick company D?
It just seems like the safest bet. It kind of reminds me of company B, except now it's more reliable. They're still investing, but they have their cash flow from the operating businesses operating businesses like now.
Right. Okay. Anybody else pick that company? Yes. Why did you pick them, Robin?
Company A, it seems like Company A's main thing with investing activities is not sustainable, and also they had to borrow a lot of money. Company B, they had something happen with their operating activities, and it didn't, it looked like they got all of their revenue basically from financing and stock issuance. Company C had nice operating activities. They looked like they borrowed everything in order to get those high numbers, and then they ended up losing money in the end because they borrowed so much. And Company C looks relatively stable, even though it has a small net change in cash compared to the other companies. It has stable operating activities. They didn't have to sell any of their equipment to get what they have. They didn't really have to borrow a lot of money to get what they had, and they could pay their dividends and still make a profit.
So you guys settled on D then, right? Very good. Okay, so let me just quickly point out some similarities and tell you what I think. So if I had to tell you, this is a startup company, brand new. This over here is a growth company, because notice they're both continuing to borrow and issue stock. So they're still growing. They're still investing in new assets. This one right here is what I would consider to be a solid state, steady state kind of company that's doing really well. This is a more mature company that's actually selling off some assets. So if I had to pick which one is the strongest to give a loan to today, who I can bank on, they're going to generate enough cash to make their payments in the future, I would probably go with company C. Okay? And it all comes down to this one thing, guys. They have such strong operating cash flows that they can continue to invest in new assets, pay back debt, pay dividends, and they're still, maintaining a really strong, there's not much of a change in cash relative to their total cash balance. So I think that's probably the strongest company of all three. All right, guys, this is just to get you thinking about what kinds of cash flows might look like, operating activities, investing, and financing activities. All right. This next example is, I'm going to try to get you into the operating section. So we're going to try to hit the operating section first. This first little section here, I want you, don't stress about taking notes. I just want you to kind of go with the flow here. So I'm going to walk you through it. Some people like to do what I call T-account analysis. So remember, in the operating section, right, you have the current assets and current liabilities. Every one of those current assets and current liabilities is tied to an income statement account. So for example, when you make a sale on account, you're going to sell the product, so you have sales revenue. And what account do you have on the balance sheet? Accounts receivable, right? Those two accounts go hand in hand. When we did our adjusting entries, you always had one income statement and one balance sheet account, right? So there's always a close link between those current assets and current liabilities and one of the accounts on the income statement. So this first time through, I'm just going to show you a company here. So if I were going to prepare a statement of cash flows, I need a couple of things. I've got to have an income statement, and I've got to have comparative balance sheets so I can calculate the change in those balance sheet accounts, right? So all I'm illustrating here, these are the current assets and current liabilities, right? So 4 current assets and 2 current liabilities. So if we take the 2016 balance, subtract the 2015 balance, I got the change, right? Every time I do a statement of cash flows problem, you have the answer to start with. What's the change in cash for the year? It's a plus 60, right? Cash went up by 60. That's the answer to the problem. When you get to the end, you have an answer key to check to see if you got it right. All you have to do is, how do you explain that change? You have to look at the changes in all the accounts that are associated with operating activities, all the accounts that are associated with investing activities, and all the accounts that are associated with financing activities. All right. So again, this first little part, I just want you to kind of go with the flow, just kind of watch. I'll post my slides after class, but I want you to see the link between an income statement account and a balance sheet account. That's all I'm really trying to illustrate this first time through. All right, so if you look at this income statement, we've got sales revenue minus cost of goods sold, minus salaries expense, minus rent expense, minus depreciation expense equals net income, right? Simple income statement. All right, so if we were doing the indirect method for calculating the operating section of the statement of cash flows, I would start with net income. Then the first thing I'm going to ask myself, is there anything on this income statement that didn't involve any cash? So is there anything here that didn't involve any cash? It turns out, when we talked about this a little earlier this semester, when we record depreciation expense, it's going to look like this, right? Depreciation expense, we're going to debit depreciation expense and credit accumulated depreciation. Does either one of those accounts look like a cash account? So that journal entry of recording depreciation expense does not involve cash at all. And so since that's a non-cash expense item, we're just going to simply add it back. We're trying to get to how much cash we actually paid or received, right? And so since that involves no cash, we're going to simply add back depreciation expense. So start with net income, add back depreciation expense. Okay, now let's look at the next item here. The next item we have, sales revenue is associated with accounts receivable, right? So I make a sale, and they haven't paid me yet, so I'm going to record it as a debit to accounts receivable. So the original entry was credit sales, debit accounts receivable, right? So my beginning balance in accounts receivable, if I go back, beginning balance was $4,900, and I added in my new sales for the period, right? And then my ending balance is $4,974. Why is that? What's missing? Is there something missing on this side of the account? During the period, did some of my customers pay me? What we want to calculate is, what's the amount of cash I actually collected from my customers? I don't want to know the amount I sold, right? That's the total goods that I sold to them. I want to know the cash I collected from them. And so if I put X here in this T account, beginning balance plus $15,700 minus X, that's the amount of cash I collected, equals the ending balance, right? I could solve for X, so if I do that algebra, I can calculate that I actually collected cash of $15,626. That's the amount of cash I collected, right? So if I'm doing the indirect method, I start with net income, add back my depreciation, and basically the change in this account will tell me what? It's the amount, because the cash received was less than the cash reported as sales. So what's the difference? The difference between those two equals the change in accounts receivable. So if I add the increase in accounts receivable here, or subtract the increase in accounts receivable here, that's the adjustment I make. So again, this T account approach is not the best way. I'm going to show you a better way in a second. So I'm just showing you T accounts work, but I'm going to show you a better way to do this. All right, next one. Prepaid rent is associated with what account on the income statement? Rent expense, right? So what happened? During the period, I incurred a rent expense of $1,500. Some of my prepaid rent was already prepaid, and I'm going to pay some more. So the question is, if I put X over here, how much cash did I actually pay for rent this period? So if I solve for X, I'm going to come up with this number, $1,478. All right, so what's the difference? The cash that I paid for rent was $22 less than my actual rent expense, right? So that difference is $22. All right, hang with me. This will make more sense in a couple of minutes. Cost of goods sold on the income statement is associated with two balance sheet accounts. Inventory, right? In order to sell inventory, I got to first buy it. So the purchase of inventory, that's what's going to go here. But sometimes I don't pay my suppliers, and so I might have a change in my accounts payable balance. So if you actually calculate this, my purchases of inventory are $78.51. And how much did I actually pay? It's going to be $78.89. Okay? So the difference between those two accounts, the increase in inventory and the decrease in accounts payable, are what caused the difference between cost of goods sold, and the amount of cash I paid to my suppliers. All right. And the last one, salaries payable, is associated with what income statement expense? Salaries expense, right? So my salaries expense for the period is $4,000. How much cash should I actually pay my employees? Well, $2,800 plus $4,000 minus X, that's the amount I paid my employees, equals $2,900. I can calculate it. The actual cash paid to my employees is $3,900. Okay, so that difference in the salaries payable account, that's the adjustment to get from salaries expense to salaries paid. All right. So this is that part that I've just shown you here. Some people like to use T accounts. It can actually be kind of confusing. And so I'm going to show you another way. It's a surefire way to get the operating section exactly right. So what I'm going to do, I'm putting a rule of thumb up here. This will always help you remember how to make these adjustments in the operating section. So assets equal liabilities plus stockholders' equity, right? Generally, what happens? When I increase an asset, what does that mean? What happens to cash? So if I'm going to increase inventory, what does that mean? I'm going to have to pay cash to somebody else, right? So it's going to result in a decrease in cash. So anytime I have an increase in any asset account, that's associated with a decrease in cash, right? How about on the liability side? If I borrow money from the bank, my liability went up. What happened to my cash? Went up, right? So on the liability side, usually when a liability goes up, that's associated with an increase in cash. All right, so guys, this is what I call the just general rule of thumb. If you just remember, assets, it's the opposite, right? So if an asset goes up, like inventory, cash goes down. If inventory goes down, cash goes up, right? So they go the opposite direction. Whereas with liabilities, they go the same direction. If I borrow money from the bank, cash goes up. If I pay money back to the bank, my liability goes down, right? So liability side, they go together. Asset side, they go the opposite direction. Does that make sense? If you can remember this rule of thumb, it'll help you remember which direction those adjustments go in the operating section of your cash flow statement. All right, so back to the same problem. Guys, this is the way I like to work the problem. Okay, so right at the top of your page, left-hand side, you'll see the information I'm about to present right here. So any cash flow problem is going to start off with an income statement and 2 years of balance sheets, right? So what I tend to do, just to the right of those balance sheet accounts, I got this year and last year, I'm going to add really 3 columns, and I'll kind of spend more time on this next time. In the first column, I calculate the change in each one of these accounts. So 470 minus 410 equals 60. What was the change in cash? Went up by 60, right? What was the change in accounts receivable? 4974 minus 4900. Did accounts receivable go up or down? Went up by 74, right? What happened to prepaid rent? Went down by 22. What happened to inventory? Went up by 51. What happened to accounts payable? Went down by 38. What happened to salaries payable? Went up by 100, right? Okay, so that's the change in those accounts. Now you have to be able to say it in words. So you have to be able to tell me, accounts receivable went up, prepaid rent went, come on guys, down. What happened to, okay, so let me just say this. So what's the direction of the adjustment? Using this rule of thumb right here. So if accounts receivable went up, what kind of an adjustment are we going to make? Negative adjustment, right? The adjustment's going to be the opposite to get to the cash number. If we say prepaid rent went down, it's an asset, right? So if it's an asset, what kind of adjustment would we make? Positive adjustment. What happened to inventory? Went up. So inventory is an asset, right? So the adjustment's going to be down. And now we're on the liability side, so now we're over here. Accounts payable went down, so the adjustment's going to be down. And salaries payable went up, so the adjustment is going to be up, right? So what I'm trying to help you just kind of visualize here, on the asset side, the adjustment is going to be opposite the direction the account went. And on the liability side, the adjustment is going to go the same direction that the account went. Does that make sense? All right, so I always do this part first. One other thing I usually do is I have to decide, these happen to all be operating section accounts. Usually I go through the whole balance sheet and put an O for operating, I for investing, F for financing. Okay, but since I'm not showing you the other sections, these are all O's. They're all associated with the operating section. All right, so if we wanted to do this, the operating section of the statement of cash flows, this is the most amazing tool. So when I was a student, I learned how to do the operating to the cash flows, looking at T accounts. And you saw that was kind of confusing? Okay, this little 3-column matrix here will make your life absolutely blissful. Okay, on the exam, I'm going to give you this little 3-column matrix on your exam so you can actually work the operating section. So I want to strongly encourage you to focus on how we do this here. All right, so what we do, we have 3 columns, right? We're going to first of all list out the income statement accounts. The first column, we're going to give the numbers right from the income statement. The second column is where we make our adjustments. The third column is the statement of cash flows. And it works every single time based on the information we recorded right here. Let me just go back and tell you one more thing. Do y'all have this written down? Has everybody got it? It's on your handout? Okay, let me just say something here. The blue arrows that I'm listing here, you have to be able to say in words what happened to the account. You got to be able to tell me there was an increase in accounts receivable. You got to tell me there was a decrease in prepaid rent. There's an increase in inventory, decrease in accounts payable, increase in salaries payable. You have to tell me in words what happened to that account, right? Now, this column right here, this tells me what direction the adjustment is going to go. I'm going to take just whatever the change is, the absolute value. So these numbers right here, once you've kind of determined whether it went up or down, we're going to take the absolute value of these numbers here and either add them or subtract them. That's how we do the operating. Does that make sense? I want to be very clear. We have to know in words whether these accounts went up or down, so we have to describe what happened. But then you're going to take whatever the absolute value of this change is and either add it or subtract it. Got it? All right, let's do it. Okay, step 1. So you guys have this listed right in the middle of your page, left-hand column. So you're going to first of all just list out the income statement. So that's already done for you. It's already on your page. You with me? So we're already done with step 1. Next thing we're going to do is we're going to back out any non-cash or non-operating items. So look to the income statement. Is there anything on the income statement? Did I not give you the income statement? Okay. Oh, yes, you have it right there. It's on the first column, right? This is your first column. Is there anything on the income statement that is non-cash? We already told you this one. Depreciation is non-cash, right? So it doesn't affect cash. So we want to just basically back that one out. So depreciation is a negative number here. Notice I show positive numbers just as a number, and I put brackets around negative numbers. Okay, so if depreciation expense is a negative number, and I want to back that number out, what adjustment do I make here in this column? Plus 700, we're basically adding back depreciation. So put that in this column right here. Plus 700, and I've made a note to myself. Why am I adding this back? Why am I adding it back? It's a non-cash item, right? That's why I'm adding it back. Step 3, you ready? We want to align the changes in those current assets and current liabilities with the associated income statement items. Okay, so looking over here on our income statement, sales. What balance sheet account goes with sales? Look at your balance sheet. You got the balance sheet there. Accounts receivable, right? We've already calculated the change in accounts receivable. What 2 accounts, there are actually 2, go with cost of goods sold? Inventory and accounts payable. What balance sheet account goes with salaries expense? Salaries payable. What account goes with rent expense? Prepaid rent, and that's it, right? So what we want to do in this next column here, remember we had to say in words, what happened to that account, right? So if we list them here, tell me, okay, what happened to accounts receivable, guys? Did it go up or down? Went up? Okay, so we're going to say accounts receivable went up, so it's called the increase in accounts receivable. What happened to inventory? It increased, right? You have to be able to tell me what happened to the account. What happened to accounts payable? It decreased. What happened to salaries payable? It increased. What happened to prepaid rent? It decreased, right? So in words, you got to be able to describe what happened to the account. That's what my blue arrows are telling you. Now, look up above. We decided what direction the adjustment's going to go, right? So I notice I put the numbers here, just the absolute value. I didn't put pluses or minuses or anything. So the change, what was well, we know that it was an increase in accounts receivable. It went up by 74. Are we going to add or subtract that adjustment? We're going to subtract it, right? Inventory is an asset account. It went up. It went up by 51. Are we going to add or subtract that adjustment? Subtract. Accounts payable, that's a liability. Did it go up or down? Went down. Look at the rule for liabilities. If the liability went down, what kind of adjustment is it? Negative, right? And so, again, let me go back here. So we're going to subtract the change in accounts receivable. We're going to subtract the change in inventory. We're going to subtract this decrease in accounts payable. We're going to add this increase in salaries payable. And then prepaid rent, what did we say? What was the adjustment on that one? Add. Okay? So again, notice, let me point out two important things. The blue arrows, we're just describing in words what happened to the account. Did it go up or down, right? You have to describe in words what happened. I took the absolute value of the change in those accounts, so I'm not putting a sign on it yet. I wrote it in there. And then based on the second column up above, we decided is it a positive adjustment or a negative adjustment based on this rule of thumb, right? And so then I put the pluses and minuses in that column. Are you with me? And now all we have to do is add across. So let's start with the first row. Sales, 15,700, that's a positive number, right? In fact, if you have your calculator, type in 15,700. What are we going to do? Minus 74, and we're going to get the number that goes on over here. Sorry. If you take cost of goods sold, we don't really need it for the indirect method, so I'll actually go through these additions later, so hold on. If you're doing the indirect method, all you really need is the net income number from the first column, plus or minus all of these adjustments, and this will give you the operating cash flow number. Okay? So that is, if you look at the yellow boxes here, that is the indirect method for doing the statement of cash flows. All right, now let's do the addition part that I was just describing. Okay, so if we're doing indirect method, you don't even need this third column really. You just need net income plus or minus all those changes, and it gives you the operating cash flow number. If we're going to use the direct method, then we have to actually do the adding across that I started to describe a second ago. All right, so if we're going to do the direct method, now we add across. So get your calculators out, or your cell phones, or whatever you have. Okay, so sales, 15,700 minus 74 is going to give us the cash flow number, 15,626. Okay, cost of goods sold, it's a negative number. So negative 7,800 minus 51 minus 38, you get a more negative number, negative 7,889. Salaries expense is a negative 4,000 already, plus 100, so what's it going to do? Make it minus 3,900. Rent expense is a negative number, 1,500, plus 22 equals 1,478. Depreciation expense, negative number, add back 700, you get 0. So guys, if you add this up, you get the operating cash flow number. The last thing we do is convert basically the income statement title, sales, to a cash flow number, right? So sales converts to what? Cash received from customers. Cost of goods sold converts to cash paid to suppliers. Again, we're taking the income number and converting it to a cash flow number, right? So salaries expense would be salaries paid, right? Cash paid to employees. Rent expense would be cash paid for rent, and nothing is 0 here. And so that gets our operating cash flow number. So if you look at the third column, and you're doing the income statement of the statement of cash flows using the direct method, this third column is the operating section. Okay, so really quickly, let me just show you the difference. If you're doing the indirect method, these yellow boxes, that's what gives you the operating section using the indirect method. Net income plus or minus all the adjustments equals operating cash flow. If you're doing the direct method, you take the third column, and that is your operating cash flow section. Notice you get the same number, 2359, either way, right? So don't worry about writing these numbers down, because in the interest of time, I just got to show you this. But the indirect method, you start with net income, plus or minus all the adjustments, and you get operating cash flows. If you're doing the direct method, you just take the third column, and you get the same cash flow number. Guys, I need you to go back and really focus on this example to make sure you understand the operating section. Question?
Why does the ACCT want you to do the direct method?
So we'll talk more about this next time. They actually require companies to do the indirect method, but you have an option of also doing the direct method. So that's kind of a weird thing. Of the two methods, we'll talk about it next time. I like this method better. It makes more sense. But yet most companies only do the indirect method. All right, so guys, we need to quickly talk about investing and financing activities. We don't have a lot of time, so just hang with me here. So investing, that's long-term assets. Financing is long-term liabilities and equity accounts, right? Okay, first example really quickly, I just need you to kind of watch. Watch, and then you're going to have to look at these examples more before you do the homework. Okay, so we've got a company here. Jasper Company's income statement includes depreciation expense of $10,000, a gain on the sale of equipment of $30,000, and if you look at their long-term assets, you've got equipment with had beginning and ending balances, and accumulated depreciation had beginning and ending balances. And then they had a purchase of equipment that cost $120,000. They also had a sale of equipment. We need to take this information that's highlighted in red and figure out the cash flows from investing activities. All right, so the best way to do this is actually to prepare T accounts. So just everybody sit back, don't stress over this. I want you just to see it, and then you can go back and practice it. All right, so the beginning balance and ending balance in equipment and accumulated depreciation, those numbers are given, right? So we just start off with equipment, beginning balance and ending balance, accumulated depreciation, beginning and ending balance. They also gave us our depreciation expense for the year. So depreciation expense would be a debit to depreciation expense and a credit to accumulated depreciation for $10,000. So we're going to make that credit here for $10,000 depreciation expense. Okay, we're going to go into this in more detail later in the class. So for this example, just kind of learn the process of how this fits together. So the three things that happen to our accounts, our long-term asset accounts, we had depreciation expense, and we also purchased some new equipment. So when you purchase new equipment, it's going to be an increase to the account. But we also know we had a sale of equipment. They don't give us much information. If you look back at the information here, it just said that we sold some information as well. We sold some equipment as well. All right, so it just says there was a sale. So when we sell equipment, it's going to decrease our equipment account. And if that equipment had some accumulated depreciation on it, we have to get rid of that as well. So we're going to get rid of its accumulated depreciation. And there's just not a lot of information here. So we're going to have to go back and solve for the missing numbers. So in this account here, if you want to do some algebra, beginning balance 40 plus depreciation expense 10 minus X, that's the equipment we sold, will give us our ending balance of $35,000. So solving for X, we go back and solve, and we can figure out that that number is $15,000, right? Now we can sort of back into this side over here. We know that the beginning balance in equipment was 160 plus purchased equipment 120 minus Y, the equipment we sold, equals an ending balance of 220, right? Solve for Y, and we can say, oh, that equipment sold had an original cost of 60. Okay, so now we can go back and fill those in. And by the way, what was the book value? In other words, how much was that equipment worth that we sold? It had an original cost of $60,000, and we had depreciated it so far $15,000. So how much was that equipment worth to us? It had a book value of $45,000. Okay? So we have to just go back and solve for those missing numbers. Okay, the last thing we're told is that when we sold that equipment, we had a gain. So go back for a second. If that equipment was worth $45,000 to us, and we sold it at a gain of $30,000, how much should we sell it for? I sold it for $30,000 more than it was worth on my books, right? So if it's worth $45,000 to me, I must have sold it for how much? Must have sold it for $75,000, right? So if you kind of go back and look at that, you say, okay, if it was worth $45,000 to me, I sold it at a gain of 30, I must have sold it for 45. What am I trying to solve for? Cash paid for equipment purchased, cash received from equipment sold, right? The two red numbers that I just solved for here are those two numbers. So my investing section would say cash received from the sale of equipment, 75, cash paid for the purchase of equipment, 120, my net cash outflow from investing activities, 45. Okay? I want you to go back and practice this example before you attempt the homework. That'll help you get it. Last section, financing activities. So in this example, it says Rose Company's accountant, Ben Kipple, has been asked to prepare the information needed for the financing section of the cash flow statement. So you've got some information about dividends, long-term debt, common stock, and retained earnings. The only way to solve this is to do T accounts. So just sit back and watch, because we've only got a couple of minutes left. First one is dividends payable is tied to retained earnings. Okay, so retained earnings, beginning balance was $350, plus net income, $33.50, minus X, whatever dividends we declared during the year, equals $820. So we can go back and solve for the amount of dividends we promised to pay our shareholders. So if you solve for X, it's $28.80. Okay, so $28.80 is what's going to go here as a decrease to retained earnings. It would be an increase to accounts payable. So now we can go back and solve for the actual dividends paid. Beginning balance plus the dividends that we declared minus the amount we paid, Y, equals $310. So the amount we actually paid was $26.50. Okay, so we've kind of filled in the missing numbers. Okay, what happened to our other accounts? Long-term debt went up. Why would long-term debt go up? Because we borrowed more money, right? If you look at stock, common stock went up. Why would common stock go up? We sold more shares to our shareholders, which means they gave us more cash. Okay, so here's our financing section. We had cash received from the issuance of stock, $500. Cash received from the issuance of long-term debt, $200. And cash paid for dividends, $26.50. What's my net change from financing activities? $19.50. So guys, hang with me. Give me 30 seconds. What we've done today, we went through an example of the operating section. And we showed you that once you do that 3-column matrix, you can either come up with the indirect or the direct method. Once you've done the matrix, you've got them both. We did a simple example of an investing section. And then we just did now an example of a financing section. You're going to have to be able to put these 3 pieces together. So guys, this is going to require you to spend some time over the weekend because the homework requires you to do all 3 sections. Don't stress. We will hit it really hard next Tuesday. Have a great weekend, and we'll see you then.